So around that frame and just really carrying forward on that thread, one of the things that we have seen is some of the leading signals of digital health adoption and digital health technology usage and overall efficacy comes from the venture world. And so we're really happy to have with us again the president of the Merck Global Health Innovation Fund and another leader that works very closely with Merck and with a number of other companies in digital health, not just recently, but over the last 30 years, Piper and DLA Piper. James Fischer is, again, a local digital health community leader. And we're happy to have the two of them here to talk to us a little bit more about what's happening with digital health adoption, particularly when it comes to legal issues and how some of the legal issues that have to be addressed by either executives in major healthcare enterprises or in startups, with startups, and obviously with investors. So with that, let's welcome James and Bill back to the stage.
So thanks for having us back on stage. I was fortunate earlier to be on the panel with Paxton and Ian, and we were talking about the viewpoint of 22 and 23 and maybe even to 24 from the investor perspective. And what I'm going to talk to Jim about is let's talk about not only from the company's perspective of what happened in those years, but what is he seeing from a legal perspective that affects both the investor and the company. So we're kind of turning the tables on the first panel that I did earlier. But Jim, before we start, why don't you introduce yourself to the audience, a little about your background and who you are?
Sure, happy to. Thanks, Bill. So my name is Jim Fischer. I'm a corporate partner at DLA Piper here in New York and in Short Hills. I practice in the M&A space, the venture capital space, emerging growth, and the corporate venture capital space. I've been practicing for about 20 years or so right here locally, and was born and raised in New Jersey. So I'm happy to kind of be able to stay local and be part of the community and get to work with Bill and many others in the community and learn a lot from coming to these events and listening to what you all have to say. And we'll try to do a good job of giving you a different perspective on what you might have heard earlier today.
All right, thanks, Jim. So let's take a look back first. What major changes have you seen in the legal environment for the digital health companies in the past 12 months? Let's take a look at 2022 and what you saw happen.
Yeah, so if we go back a year ago, you all probably noticed it, I'm sure. We certainly did as lawyers. The fourth quarter of last year was a very vivid time, a very quick time, and it was probably unsustainable in many respects in terms of just how people were exiting, how they were raising money. And you fast forward a year through a bit of a difficult year and a difficult process, and you're starting to see sort of a little bit of the opposite of that. So from a pure valuation perspective and things of that sort, from an exit perspective, obviously we're still, we don't look at it as a downturn, but more of a transitional market that we're in at the moment. And that's true from the business side, but also from the legal side. So we are certainly seeing, deals that are stretching out longer. It's taking longer for buyers to get comfortable with exits. We'll talk about that. It's taking a little bit longer in some respects for money to be invested in or that second round to come in. And it's not because the companies aren't properly valued or sort of worth the investment, but there's a little bit less urgency in some respects to depositing that money as quickly as there was, say, a year ago, even 18 months ago. And there's also an interesting sort of, I guess, change in terms of many farms are raising money right now. There was so much money deployed last year that many have said, okay, let's sort of take a step back. What did we do? What's working well? What's not working well? How do we kind of strategize with our own portcos in terms of making sure that our portfolio looks the way it should and is growing the way we want it to grow? And then in terms of just the market environment, and I'm obviously not a financial advisor, but from what we hear and see from bankers and friends in that community, there's still that desire for alternative investment vehicles, and so you're starting to see a lot of funds go out and raise that second, third, fourth fund. And in your space, obviously in the CVC space, we're certainly seeing that same kind of commitment to where do we go from here? So I would say that's where we sort of are seeing things, a year ago to today. Now, in terms of just deal terms, certainly things as markets tighten, obviously the company can feel a little bit more constrained in what it can do. It might feel a little bit less in terms of who's at the table, how vigorous they are. what kind of terms and conditions they want. If there's commercial arrangements, what do those commercial terms look like? What can they benefit from? What can they show to the investor that maybe somebody else can't? Whereas last year, that was probably a little bit less of a focus because there was such this urgency to kind of get money committed and get it done by the end of the year. So certainly seeing a little bit of that transition.
So I mentioned in my panel that as a fund, we did a lot of notes last year.
Yeah.
And I'm curious what you might feel as, or what you might see potential ramifications of the companies doing those notes because they couldn't necessarily fundraise, and what are maybe the consequences from a legal perspective of from the company's viewpoint of taking those notes?
Yeah. So I think a lot of companies, over the course of this year found themselves in a position where they frankly would like to have gone out and raised more money, but there are two things that kind of happened. One, they might have raised money at a very high valuation, say a year ago or 18 months ago, and they set that expectation, which is always sort of an interesting conversation. Again, as lawyers, we're trying to help our clients as best we can in all facets, and obviously our principal idea is to provide legal advice. But there's always that sort of challenge, and you're talking to people about, do you really want to set that valuation that high? Because you're going to have to demonstrate where it goes from here. And that we've seen because of that, in many cases, people weren't able to kind of show that valuation. They didn't want to do a down round. So obviously a down round or a flat round is never sort of a good sort of situation for somebody to be in. So income, the notes, and also safes, as you all have probably kind of seen. And I think the repercussion of that, I think, is largely sort of, I would say, as we move forward into next year, it's in the market. People know, I think, that are in this space that, many companies did that for various different reasons, but principally because they either wanted to raise more money and couldn't. The round that they raised wasn't enough, so they needed a bridge before they kind of create that more, that sort of ramp in their valuation come a year and a half from now, or what have you. Or generally speaking, and hope this is not the case, obviously, but there's an element of we need this money or we can't really evolve forward. And I suspect you'll see that going into the next quarter or two as well.
Okay, let's look forward now. Let's think of the next 12 to 24 months as we move forward. What do you kind of see as the legal outlook for the companies and for the digital health community going forward?
So I think one of the things that we're really focused on, and I'm fortunate to work for a global law firm. We have offices in 90 countries around the world. I should say 40 countries around the world, 90 offices. And many of those countries, we have an FDA-like practice. And so we're seeing a lot of focus on what the regulatory environment looks like in various different jurisdictions. And not just what you would think about in terms of the regulatory environment, not antitrust issues and things like that you all are accustomed to, but more of the real sort of diligence into, okay, how are these products evolving? Who are they servicing? Where are they servicing? Where is the cross-jurisdictional issues coming into play? And we're sort of really focused on making sure that people are prepared for those issues, because as you think about how the companies evolve over time, if they haven't laid that groundwork on some of those issues, that can really become a problem later on. We hope to help you in the beginning and not, at the end, rather kind of prevent the problem than have to solve for the problem. We're certainly seeing a big uptick in sort of regulatory matters and just, I would say, diligence in general. When you sort of in a position where the markets aren't quite as frothy, people do tend to take a step back and they're willing to kind of pay a little bit more attention to diligence, principally because they might have a little bit more time. And maybe we're talking about a week or two as opposed to, I got to get it done tomorrow. But that week or two can probe, and they can look to questions and things of that sort. And we'll talk, I think, a little bit about kind of what we would suggest people do. But we're certainly seeing more of a level of diligence. I expect that to continue. I expect people to be a little bit more probing in kind of how they think about what the companies are doing. And then I would say many times we're fortunate to be in the investor presentations, which is always sort of an interesting viewpoint for us because we learn a lot. We're seeing a lot more questions that are very targeted and direct, as opposed to a little bit higher up in the sort of the elevation.
So you mentioned regulatory. Can you go a little more detail of really what you're seeing as it relates to funding opportunities?
Yeah. So, in terms of, and when you say funding opportunities, you mean certainly people investing into companies. So I think it depends largely on what stage of the investment you're in. And if we talk about very early stage companies, I think it's the key for them is showing the path forward and what the plan is with the money, and that the money is actually going to be used in part, not only to obviously raise the profile of the company and the product line and things of that sort, but that you've laid the groundwork so that you're not fixing problems that could have been dealt with on day one. And in the regulatory environment, largely that is, are you getting your products, approved in a certain way? Are you thinking about kind of what other applications could exist that might lead to different sort of legal scenarios or challenges? Are you engaged with counsel that can kind of provide a broader brush of focus, right? Not just a fund lawyer, or not just a transactional lawyer. Again, I'm fortunate to be at a firm where I certainly don't know everything, and being able to bring in those regulatory lawyers, whether it's FDA lawyers, whether it's antitrust lawyers, whether it's cross-border lawyers, to sort of have those conversations more globally is important. And frankly, I think it does help us kind of stand out a little bit in that regard.
All right, let's talk about the exit market.
Yep.
How, if we look at, the funding going forward, we had mentioned earlier in my panel that the sort of the healthcare SPAC market wasn't really that good. IPO is a little on hold, but how are you sort of projecting and advising going forward your companies as they think about exiting?
Yeah, so let's talk about SPACs for a second. We've all seen them, we've all heard about them. If you had asked me that same question, last year, I would say we are doing SPACs every day of the week, whether it's forming them or de-SPACing, or taking a company that was, a SPAC back private so that it becomes a SPAC again. It was sort of this cycle. That cycle is clearly depressed in two ways. One, the SEC, FINRA, other regulatory agencies are very focused on the accounting of SPACs and sort of what's happening along those lines. So what I would say is, if you were thinking about an exit and the SPAC being that exit, that is going to be more challenging over the next period of time. I wish I could tell you how long. I don't know for sure, to be honest with you, but I don't think you're going to see a robust SPAC market in this coming 12 months. And you're unfortunately seeing the worst case scenario in some respects, which is SPACs just sort of saying, okay, we're actually going to shut down. We're going to return the capital before their window closes. So that's never sort of a positive sign, unfortunately, in the SPAC market. The other thing I would say with SPACs, and then we'll move on quickly, is I would just be careful when you're talking with a SPAC about their motivations and what they're doing and not doing. How quickly can they get something done? How many deals have they done that didn't sort of happen or didn't close? So it's a fragmented market. The capital market's a little bit challenged at the moment in terms of certainly the IPO market and the secondary market. But I would say the M&A markets are still very robust. We're fortunate to be very busy. We're still doing a lot of exits and a lot of sort of whether they're small exits or large exits, and they're global in nature. So I don't see sort of the same sort of scenario with SPACs or the capital markets as we do in the M&A markets, largely because there's a lot of money that has been deployed, and obviously there needs to be an exit.
Okay, well, last question, because I know we're just about out of time, is what advice would you give, a CEO or CFO who's looking to exit next year?
Yeah, I would say use this next period of time to be as prepared as you can possibly be. Make sure your diligence is locked down. Make sure your investors know kind of what is happening. Make sure your advisors are aware. Don't bring them in at the last minute. I understand that can cost some money, but I'm telling you, I really sincerely believe that the earlier you advise, you get your advisors involved in the process, the better off you'll be. They can help you to prepare for some of what they're seeing, some of the questions that you might be able to kind of answer in preparation for what they've seen or will see. And it makes you look as though you're standing out. You've prepared, just like any of us would do to prepare for our work day. It puts you above that person who has to say, well, let me get back to you. And so I would say prepare.
All right, well, thank you. Thanks, Jim, for sharing your
Thank you.
insights today, and thank you for listening.
Thank you.
Appreciate it.